This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I've done a podcast on Apple before, and I'm going to do a second one because I just saw a really interesting article that was published over a month ago, and it's called Following a Herd of Bulls on Apple by James Stewart, who I think wrote Barbarians at the Gate years back. And I saw this piece because the original turtle trader Jerry Parker had posted it on his Twitter, and I thought it was worth reading and giving some comment on it. The article reads, quote, "Last September, Apple shares hit a record $705. And to the overwhelming majority of Wall Street analysts, that meant one thing: buy. By November, with Apple stock in the midst of a precipitous decline, they were still bullish. 50 of 57 analysts rated it a buy or strong buy. Only 2 rated it a sell. Apple shares continued their plunge, and this week we're trading at just over $450, down 36% from their peak. How could professional analysts have gotten it so wrong? It wasn't supposed to be this way. A decade ago, congressional hearings and an investigation by Eliot Spitzer, then the New York Attorney General, exposed a maze of conflicts of interest afflicting Wall Street research. There were some notorious examples of analysts who curried favor with investment banking clients and potential clients by producing favorable research and then were paid huge bonuses out of investment banking fees. Many investors and regulators blamed analysts' overly bullish forecast for helping to inflate the dot-com bubble that burst in 2000. After a global settlement of Mr. Spitzer's investigation by major investment banks and the Sarbanes-Oxley reform legislation in 2002, investment banking and research operations were segregated. Conflicts had to be disclosed, and research and analyst pay was detached from investment banking revenues, among other measures. These reforms seem to have worked, but only up to a point. Other conflicts have come to the fore, especially at large brokerage firms and investment banks. And studies have shown that analysts are prone to other influences, like following the herd, that can undermine their judgments. Quote, "The reforms didn't necessarily make analysts better at their jobs," end quote, said Stuart Gilson, a professor of finance at Harvard Business School. "It may be no coincidence that the only analyst who even came close to calling the peak in Apple stock runs his own firm and is compensated based on the accuracy of his calls. Carlo Bassignus, founder and chief executive of Creative Global Investments, downgraded Apple to sell last October 3rd with shares trading at $685. In December, he lowered his price target to $420. And this week, he told me he may drop it even further to $320. He founded his firm a decade ago after spending many years in research at Merrill Lynch and Lehman Brothers. Quote, "I saw so many conflicts of interest in trading, investment banking, and research, so I started a conflict-free company," end quote. He said this week from Luxembourg, where he was born and now lives. Quote, "Wall Street is full of conflicts. It still is and always will be. It's incompetent at picking stocks," end quote. Since the passage of Sarbanes-Oxley, several studies have documented a decline in the percentage of analyst buy recommendations, albeit a modest one, while sell recommendations have increased. Quote, "Before 2002, analyst recommendations were tilted toward optimistic at an extreme rate," end quote. Ohad Kadin, a professor of finance at Washington University in St. Louis and co-author of one of the studies, told me this week, quote, "That's still true today, but it's not as extreme. It's a little more balanced," end quote. While investment banking conflicts have been addressed, quote, "The most obvious conflict now is that research is funded through the trading desks," end quote, Professor Gilson said. Quote, "If you're an analyst and one way your report brings in revenue is through increased trading, a buy recommendation will do this more than a sell. For a sell, you have to already own the stock to generate a trade, but anybody can potentially buy a stock. That's one hypothesis about why you still see a disproportionate number of buy recommendations," end quote. That may be especially true for heavily traded stocks like Apple, which generate huge commissions for Wall Street. Okay, I'm going to pause here for a second. Stick with me. I want to read this through, and then I'm going to offer some commentary. The article continues. But no one thinks conflicts alone can explain the analyst's abysmal recent Apple performance. Quote, There's too much unanimity, end quote. Bruce Greenwald, a professor of finance and asset management at Columbia Business School and a renowned value investor, told me this week, quote, "That's what's so troubling. When that many analysts are in agreement, they can't all be conflicted," end quote. He and other experts say there are additional documented factors that help explain why Wall Street analysts are so often wrong. They extrapolate from recent performance data. They chase momentum. They want to please their customers, and they show a tendency toward herd behavior, which is to say they fall into the same pitfalls that afflict most investors. Quote, "Why aren't they more sophisticated? You'd hope they would be," end quote, Professor Caden says. Quote, "But they always fall into these same traps," end quote. Professor Greenwald agreed. Quote, "When something goes up, they all put out buy recommendations. Their models extrapolate past performance into the future. They chase momentum. With Apple, they were right at 600. They were right at 650, which reinforced the trend. So why would they be wrong at 700? Question mark, end quote. Professor Caden said that momentum investing has its adherents and is often right, at least in the short term that many investors focus on. Quote, "You'd hope that analysts of all people would be able to participate in an abrupt reversal, but they're not very good at it. They loved Apple at 700. I'm sure they're trying to do their best, but they're prisoners of momentum," end quote. Another factor is that analysts have a tendency to tell their audience what it wants to hear. Quote, "The analysts are in the end salespeople," end quote, Professor Greenwald said. Quote, "Their credibility depends on their not upsetting their investors too much. Everybody loved Apple. Everybody did well. The bears were always wrong. It took an enormous amount of courage to fight the tide," end quote. Professor Caden agreed. Quote, "Analysts tend to herd. There's no big penalty if you're wrong because everybody else is wrong. You've got cover. You're not going to lose your job. If you take a different opinion, either you get a big prize if you're right or you lose your job. An analyst needs to be really courageous to say something different from most other analysts," end quote. Mr. Besnius, the one analyst who downgraded Apple near its peak, said, quote, "I'm not afraid to make big controversial calls," end quote, but attributed his decision less to courage than to survival. Quote, "I'm paid based on performance," end quote, he said. Quote, "I have to go to my clients and explain why they should pay for my research when they can get it for nothing from firms where they pay their trading commissions," end quote. Mr. Besnius based his recommendation on technical factors. As Apple hit 700, its upward momentum and trading volume were slowing, as well as more fundamental concerns about product quality and innovation, as well as growing competition from rivals like Samsung. And there were more subjective factors. Mr. Besnius said that he became uncomfortable with what he deemed Apple's arrogance. Quote, "I love Steve Jobs," quote, he said. Quote, "He built a great company, but he was one of the most arrogant CEOs I've ever met. The way he introduced new products was one big display of arrogance. He ridiculed Microsoft as micro-who. That's a good reason to be cautious. A little humility is a good thing," end quote. It galls Mr. Besnius that market regulators don't measure the performance of Wall Street's research recommendations. And he said he believed that they should require firms to disclose the track records of stocks their analysts recommend. Quote, "They're not being held accountable," end quote, for bad recommendations, he maintained. Quote, "Little firms like ours have to be better than the big firms. We have to prove we can add value. Otherwise, we wouldn't have an existence," end quote. Apple is only one prominent example of egg on analysts' face. And bullish Wall Street analysts were right for years until they were wrong. Even today, analysts remain overwhelmingly positive about Apple. This week, 44 analysts rated a strong buy or buy, although 10 now rate it a hold, according to Thomson Reuters. Should anyone listen? Many brokers still rely on analyst research and offer analyst reports to clients for guidance in picking stocks to buy and sell. But the Securities and Exchange Commission takes a skeptical approach. Despite the reforms it helped put in place, it warns on its website of continuing conflicts of interest and says flatly, quote, "As a general matter, investors should not rely solely on analyst recommendations when deciding whether to buy, hold, or sell a stock," quote. It notes that many brokers aren't allowed to contradict recommendations from their own research departments. Professor Gilson of Harvard said, quote, "Analysts are like movie critics. Some are good and some are bad. I find some of them extraordinarily useful. I advise my students to look to them, but you have to read their recommendations smartly with a very critical eye," end quote. Professor Greenwald was more dismissive. Quote, "I never pay attention to them," end quote, he said. Quote, "When a dog barks, if the dog barks all the time, you stop paying attention," end quote. That's an amazing article, right? An absolute bundle of nonsense. The people that they bring on to criticize the Wall Street analysts, and I'm not here to defend the Wall Street analysts, because anybody that reads a research report from a Wall Street analyst and makes a buy or a sell based on this, after looking at the last 20 years of Wall Street history, is an imbecile, is mildly got issues, maybe majorly has issues. I mean, anyone out there that is listening to this nonsense and making decisions with their money is crazy. But isn't the funny part of that article the people that were quoted in it? The people that were quoted in it. And happens to be also interesting to note who the author was. Jim Stewart has been around Wall Street for a long time. I think he dialed this piece in. He knows it's impossible to predict Apple's top. So they find one guy out there that pegged the top, and we're all supposed to look to this guy as some kind of miracle worker? Are you serious? You don't pick tops. People that pick tops, like an Apple at 700, are lucky. It's not a skill. And if you can only find one guy to do it, and my gosh, have I ever heard people say, Covel, you in this trend following, you found all these lucky survivors. Well, let me tell you right now, the one guy that Jim Stewart found to pick Apple at the exact top, was he not the lucky survivor? I mean, truly, that was the only guy you could find that picked the top, and then you build the article around him? So let's put Jim Stewart off to the side for a second. He's clearly got conflicts. Look to who writes these articles. I mean, like I said, Jim's, he knows what's going on. So I don't know if he just dialed this one in and wasn't paying attention, had a research assistant write it. Who knows? This other guy that picked it at the top, you know what? Let's let him pick the next great stock at the top before we give him any credence for his skill set there. He picked Apple at the top. Fantastic. I save my ire for the professors, the good professors at the fine universities, the men who teach that markets are efficient. Nothing like reaching in and asking the good professors, the ones that have the basics of finance wrong and continue to push this nonsense to their students nonstop. Markets are efficient, markets are efficient, markets are efficient. And then when Jim Stewart wants a quote, he calls up a guy who's a professor of finance at Harvard. Because let's face it, if you're writing an article in the New York Times and you quote a professor of Harvard, it makes it look like you've got all your ducks in order. But why don't we analyze the professor at Harvard for a second? Why is he not discussed? What does he do? What does he do that's useful for society? Seriously. What does he do? Absolutely freaking nothing. And that's the big scam. The big scam is that all these people that are out there writing this research mumbo jumbo probably sat through that very professor's class or the other professor's class. Wall Street is populated with all of these people that sat there and got this nonsensical finance education. And then the professors show up in the New York Times article to say, I can't imagine this. I tell my students to read the research reports with a critical eye. I tell my students to read the research reports with a critical eye. What does that mean? What does that mean? A critical eye to what? There's no specifics. It's like Jell-O. It can mean anything to anybody. It's like this just sponge that undulates back and forth. It doesn't mean anything. I tell my students to look with a critical eye. When the dog barks, if the dog barks all the time, you stop paying attention. Well, maybe we should stop paying attention to the professors because they've been barking the wrong thing for a real long time. The efficient markets, there's no outliers. There's no edges. Right skew? Nobody can find the right skew. It doesn't exist. Look, finance, and we can go in a lot of different directions about teaching and the education that students receive. And Seth Godin has done some fantastic work on this. But let's just talk about finance for a second. Finance on universities is a scam. Every dollar that you pay is money that goes to a scam. What am I talking about? What do you mean, Covel, it's a scam? Look, these goofballs are sitting in these plush universities with tenure. They're going to be guaranteed money for the rest of their life so they can sit around and look at 22-year-old rear ends of cute college co-eds. This is the pervy world of tenured professors. Let's just be frank about it. And oh, by the way, my first book, Trend Following, was published by Pearson, a textbook publisher. So what do you learn as an author who I've written 3 books with Pearson? What have I learned about the business of textbooks? It's a great freaking business. Now, my books weren't textbooks, but let me tell you, it's a great business. I've learned a few things over the last nearly decade in dealing with Pearson and hearing about what goes on. If you're a professor and you publish a textbook, even if the content of that textbook is 100% fallacious, 100% nonsensical, markets are efficient. Nobody believes markets are efficient. But if you publish a textbook and you get it out there and everybody has to buy your textbook, you can make millions of dollars. So not only do you have the tenure, not only do you have the ability to go to the college cafeteria and sit around and, stare at young girls all day long, you get to make millions by selling textbooks. And then, oh, by the way, when Jim Stewart needs a comment in the New York Times, he calls you up and he makes you look really good in the article. And these bad Wall Street analysts that you trained in your classes, then you turn around and say, oh, they're all very bad. Except they're doing the same nonsense that you taught them to do. One other thing in the article talks about momentum. Well, there is nothing wrong with momentum. A great way to have traded Apple is through a momentum trend following style. And a momentum trend following style never would have had you getting out at the top. It would have never had you getting in at the bottom. It would have had you getting late into the trend and late after the trend. And all you can hope for is to capture the middle meat of a big move like Apple. Getting in late and getting out late after it peaks. Trying to pick the top. The premise of this article is disingenuous at worst and just flat out dishonest. Maybe at worst. Disingenuous at best, dishonest at worst. Let's pick the top. So think about that. Momentum is fantastic. It is a fantastic way to trade. But you have your stops in place. You let your profits run. You go ahead and your stop gets hit, you get out. That's the way it works. So I always enjoy seeing a fun article like this, an article that frankly needs another vantage point. Somebody to sit back and say, who wrote the piece? What was their agenda? Who are the people quoted in the article? What was their purpose? Now, of course, none of this is related to trend following trading. You don't need to know any of this. But part of my guiding light, part of my passion is to win over people, to get people to see a different way, to get people to see the trend following way. And the trend following way doesn't require you to be worried about whether or not Wall Street analysts are right or wrong. It doesn't require you to be worried about whether or not Jim Stewart had an agenda when he wrote this piece in the New York Times. It doesn't require you to be worried about whether or not a Harvard University professor has conflicts of interest himself and makes a bunch of money selling textbooks. Trend following doesn't require any of that. I only bring it up to make a point. I bring it up to sharpen the divide between these different ways of looking at the world. And they are very different ways of looking at the world. On one side, you have all of the university shenanigans, the efficient market nonsense. You also have Wall Street on that same side of the coin, giving you buy, sell, and hold recommendations, something that's never going to stop. You also have on that same side of the coin, adulation for the one guy that picked the top. On the other side of the coin, you have trend following traders who know that absolutely all of that is junk. Junk science, junk for the mind, information overload, and completely useless to making money. Trend following, on the other hand, looks at Apple and says, it went up to 700. I rode that sucker all the way up. It started coming down and I got out late. And I can hope to capture the middle meat of it. And that's it. There's no passing the buck. There's no saying, I'm not responsible. You're responsible. And ultimately, isn't that the big picture view of this article? Somehow or another, this article that Stuart wrote is ultimately designed to absolve investors of no responsibility. If you trust a Wall Street analyst and the Wall Street analyst is wrong, well, you didn't make a mistake yourself. Because personal responsibility has gone out the window. Personal responsibility doesn't exist. It's been eliminated. So, as I sound a little passionate today, take all that stuff over there. The Wall Street analysts, the professors that taught the Wall Street analysts, Jim Stewart and his agenda at the New York Times. Put all that over to the side and then go a little zen. Go a little zen. Go read zenhabits.net. Do some yoga. And then maybe wake up and learn a little bit about trend following. Make your life simpler. Walk away from all the nonsense. I just love articles like this, though. It gives me a chance to sharpen the divide, to put the width of that Grand Canyon as wide as I can possibly make it. And it is super wide. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.